execution, and
No,
they're not marking our shit right.
I know, and it's just this data, man. This fucking data. God.
Did they hit you up on the solution for the data? Like no solution.
It's just no way some of those trades could have went down. And everyone was here watching me. At one of them, I was like, "All right, I'm done," and they started laughing.
Yeah, yeah, no, I hear it. Yo, guys, we're live now, and welcome to Sang Lucci Mailbag. Brian and I were actually just talking about some data problems, and if you guys don't know, like Brian's a big vol trader, and he's got this platform that essentially has this thing called an electronic eye, right? And so, Brian, correct me if I'm wrong. I just want to try explaining this, right? So there's an electronic eye that kind of detects orders coming in that follow what Brian has for like his settings for a vol setting or any setting in general, and then it automatically trades it. So it's pretty much black box, I think. And I guess there was problems with the opera feed. So the opera feed is pretty much they consider it the ginormous fire hose out there of options data pumping through, and it's going to Brian's platform. Brian, can you tell them a little bit about like what you were actually seeing that was problematic and how that is like issues for market makers and all that?
Right. So, the question is, where did this problem come from? And from the way I saw it, is that I traded an option because, well, let's start with the machine traded an option because the machine felt that there was edge, and the edge is determined by the option and the option strike and the stock price. The problem is sometimes you have bottlenecks in data where the stock price is not actually accurate, and it fires off a trade. It might think it's selling a put or a call or buying a put or a call because there's edge. It might be selling the same price, but the problem is that the stock
It's not
is
the real price, right?
It's not the real price of the stock, so it's not the real edge
Yeah.
of the option. So I think that I'm selling a put above its value based upon my black box theoretical value, but in reality,
Oh,
it's not worth that amount. It's worth more or worth less because the stock has moved. So when the underlying moves slowly, then or there's like a blip, then all of a sudden the option value stays at that price even though the stock has moved. So it's really not valid.
okay.
And
So it was actually your stock price feed that was screwed up. It wasn't the options price feed.
that's what I'm anticipating is the problem, and that makes more
Oh,
sense.
gotcha, gotcha. All right, all right. Well, unfortunately, the data went down today because there are some ginormous moves. So, like, I mean, the SPOOs were just freaking going nuts, and all these names looked like they were puking lower, and then all of a sudden made highs today. So, like,
Amazing. It was amazing.
I mean, this would have been a really juicy day for you, right? As a pseudo market maker or like a
Yep.
portfolio manager that makes markets, right? Tell us
Yep.
why that it's a good day for you.
Yeah, I mean, so there's a lot of vol. So, hold on, we're getting an echo. Anybody we can mute some of that echo? Turn that down.
How's that? How's it now?
That's
Any
that's
better?
fine. Yep, great. So it's kind of still echoing, but I'll just forget. I'll focus on the issue, and the issue is that a market maker market makes volatility, and so if the stock is moving, then the volatility there's volatility in that actual volatility. It's called vol of vol.
Hmm.
And so if the stock is moving, then a market maker is going to be trading the volatility input, which is going like this and like that, and then they're just collecting edge. And also, when you see a move back, in a mean reversion move in the stock, you can anticipate how the curve has moved from the initial move, and then how it's going to move from the mean reversion move.
Sure, sure. So,
And
if for those guys that don't understand mean reversion, it's just essentially the SPOOs broke down today, right? Broke down under 194, went all the way down to 192.35, and then the mean reversion is simply the move back up there. And what Brian's saying is that market makers, since they are not in price space so much, they're in vol space, is that when there is actually a mean reversion in stock, that you can anticipate the movement of the actual vol curve pretty well, right? I mean, if there's actually real mean reversion, you just follow this thing as
Right.
it smiles the other direction.
What you're doing is you're gray boxing your position. You're manicuring by saying that I want to buy. Say we're talking about like weekly Netflix.
Mm-hmm.
I want to buy puts, hedge them. I want to sell calls and hedge them. The thing is, you have to like kind of anticipate. Are we going to go through a certain price level? If you do, I'm getting ahead of the game, I'm getting more advanced. But you have gamma involved. You don't want to sell a call and the stock flies through that call because it goes from a 30 delta to a 70 delta, and you might have lost a bunch of money.
Right.
So it's like I'll sell some meteor calls as we go up, but I can't put on a static position. So that's kind of one approach.
Sure, sure. So let's see. Everybody keeps telling me to turn down my audio. Is my audio high?
The echo is getting crazy and I'm going nuts, but I'm trying to stay composed.
Hold on. Is this any better? This better?
Test.
Test.
Yep. Way better.
Yeah. Way better. Okay.
Excellent.
I just like my audio high.
I don't even know what I was just talking about just now, but it was definitely even better.
I got a little lost too because I was asking about your conversion joint. So let's see. We got a couple questions here. Faisal is just asking, do you look at any analysis of geopolitics determine your market bias? Cheers. No, I don't think any of us really do that. I think Lucci, what he would do in general is he would come up with certain variables that would count towards his big picture kind of idea in the markets and slowly build a position there, but definitely no over analysis of geopolitics. We're traders. We don't care about stock valuation. We don't do any of that. So Hal's got a question here. So I was watching Apple one day right after it opened, the price just whipped up then down. Are these algos pushing the price up and down so quick? And also I see sort of the same thing near the end of the day on some stocks also. So Brian, you want to give Hal kind of your thoughts on it, and then I'll give them my thoughts on
I
this?
just got a phone call from Lime, so I missed part of it. But what I heard was that Apple goes up and then goes down, and then what happens? Is that what we're talking about?
That's in the morning, and then in the afternoon it does the same thing. It's whiplashy in the morning and the afternoon. I'm asking if it's algos or not.
I mean, it could be algos, but it could also be you're releasing in the morning. First of all, the echo is still there. But second of all, you have market orders to buy and sell, right? And if the market makers, enter things in a different, it's kind of manipulation, sort of. It's like letting the market makers buy a bunch, and if their theory is like if they're buying a bunch, it's not necessary that they're going to be selling out of their position. If all that, so customers sell and then the market goes down and they buy, and then they have buy orders from customers. The thing is, it's like we're not manipulating. We're not like we're doing the buy orders and sell orders kind of separately. They take one side and it's kind of sentiment. Well, we're providing liquidity. Because the customer sold, maybe the market could continue. So we're still like, we're still providing a service.
Sure.
There might be other people that get triggered. So that validates why they do them separately. So they buy and then they bring it back up to some medium, and then the buy orders from the customers. So it's like separating customer sell orders and buy orders.
Mm-hmm.
And they're basically catching. I see that all the time.
Sure.
You see the opening sell orders, and they catch the falling knife, and then they either move it up or other people like see that it's happening and they force it up, and then the sell orders come out from the.
Right.
So it's like separating buy orders and sell orders of customers on the open and the closed.
And it doesn't necessarily even have to be algos. I mean, I feel like.
Right.
Generally, there's more volume in the morning and more volume towards the end of the day and a bunch of shit during the day.
Right.
And so the volume in the morning and the afternoons essentially means to me that people want to get into positions or out of positions. There's more volume, meaning more liquidity, or maybe that's wrong, but generally I think that's correlated. More volume, more liquidity, more ways to get out or get into a position with less slippage on the spread. Also, if there's enough volume and you're a big dude and you're just trying to get into the market, what is the best way to not affect the market? When there's enough volume that you can just get into the position and not, shove the market up $5 during the day when there's no real liquidity there. So I would say the speed, yes, there are probably really fast market makers involved with collecting spread all along the way in the fast movement, but I would say the real participants that are moving the markets are actual players. I personally think that they are actual players that are working in or out of positions and in or out of hedge positions too.
Actually, that makes sense. So, because I'm not a market maker in stock, all right. So I always come up with conspiracy theories as well, and especially Apple, because that was my baby for 2 years, and I saw that shit. And the thing about it is so much interest. Is that so? Maybe we sit for the first 5 seconds, or maybe even not. If there's one guy that wants to sell, so yes, he's taking advantage of the liquidity and he sells. And then there's a guy that wants to buy, and then he buys and push it up. Then there's someone that wants to sell higher than the open print and sells up there. So that causes those kind of 3 movements.
Yeah.
And then after that third one, and it comes back down, then the guy that has the staying power, someone that really wants to do something. Maybe there's other sellers that come in and keep driving it after that. But as you can see, a name like Apple, there's a lot of volume and width in that first 3 minutes, and it's because of the interest in Apple. Yeah, there's people taking advantage of that situation. So it's 3 different people that are coming in at that time and forcing it, and then there's one person that has the extending order.
The super order, right?
Yeah.
Yeah, and they may actually not even be price sensitive at all during the day.
Right.
Just be purely liquidity sensitive. I just need to put on $2 billion worth today of Apple.
Exactly.
And this is how I got to get in, and I'm just gonna wait till I see big bursts of volume, and I'm just gonna shove myself in there.
Because if you look back to Apple when it's $700, $2 doesn't matter to them that are putting on 1 million shares of Apple. They're not doing it for $2. They're doing it for $200 or $100 or $50. So yeah, they're just looking for liquidity.
Sure. Sure. Let's see. I mean, these other questions are kind of all right. I mean, what effect do you think Bill Gross leaving PIMCO will have on the markets? I don't think anybody really cares. In times of back and forth action, where is the best place to find edge? Back and forth action.
The back and forth action. What does that mean? Does that mean?
I guess that's just lots of mean reversion.
An oscillation.
Lots of range oscillation. Yeah.
Well, where's the edge? The edge in the options or edge in the stock? If we're talking about the options, it's edge in selling. It's edge in selling. If you want to get into a straddle or strangle, then you're going to want to go against the market for one of your legs. If we're going up and you want to sell a straddle, you're going to want to sell the more in the money part, which is the call at that point. Sell into that upward move and then wait for it to come back down. We're kind of oscillating because there's no huge volume, so the movement is normalized by volume. If there's no volume, eventually the buyers are going to be gone, and then the market makers are going to see asymmetric bids
and then they're going to lean on one side and
and so you sell that call when you see that exhaustion, that normalized exhaustion relative to the market at that static moment in time, and then you sell that call and you buy that put, and then if that's what we're doing, then you're going to collect the time decay. Yeah,
totally. I mean, oscillation is I think oscillation sucks for stock traders. I mean, it's nice and all that, but it's if you're a scalper, it's great, but it's kind of it's also tiring for the hand trader. The longer you have to sit in the markets and actually say, I got to now turn my direction, each time you turn, there's an oil rig in your brain that you have to turn and say, I'm going the other way. And that brain gets pretty tired after a little bit. So if there's some way to automate it and kind of quantify oscillation, maybe it'd be good. But, I mean, Yeah, like Brian said, you got to be a market maker. You have to have a lot of automation in order to actually be able to fully take advantage of it. But I mean, that's pretty much all we got, guys. I want to make sure that you guys are checking out the new website. It is pretty fly right now. We made a couple notes that Dirty Automatic here, Brian, it was pretty much PhD material. We will be launching classes soon, Brian. Just wait and see. If you guys want to learn more about actual options theory from a practitioner instead of from, say, your college professors, I guarantee you this is much better because I spent 4 years in school trying to learn it and not being able to understand diddly squat in the actual options market, bids and offers, and where they fall on vol curves and all that until I actually got into trading and listening to Brian. So, guys, really appreciate you having on. Lucci is in Vegas. We may do a show in Vegas. But yeah, hopefully everybody had a good one. Over and out. Thanks, Brian, for joining us.